Hi, I'm Lorna Illingsworth, an independent financial advisor for Protection Investment Southampton. Today we're going to discuss interest-only mortgages. An interest-only mortgage is exactly what it sounds like. Your monthly payments only cover the interest charged on the loan. You're not repaying any of the money you originally borrowed. So for example, if you borrow $200,000 on an interest-only mortgage, at the end of the mortgage term, you will still owe the full £200,000. That balance must be repaid when the mortgage ends. This is one of the biggest differences between interest-only and repayment mortgages, where you gradually pay off both the interest and the loan itself over time. Because you're only paying the interest each month, your monthly repayments are usually lower than they would be on a standard repayment mortgage. However, lenders tend to be stricter with interest-only mortgages. That's because there is more risk involved for both you and the lender. You need to be able to clearly show how you repay the full loan at the end of the term, and you'll usually need a higher deposit. While many repayment mortgages require around a 10% deposit, interest-only mortgages often require 25% or more, depending on the lender and your circumstances. Anyone can technically apply for an interest-only mortgage, but they are most suitable for people who are asset-rich, have strong investment portfolios, or have a reliable repayment strategy in place. They're very popular with landlords, as most buy-to-let mortgages are interest-only. This keeps monthly costs lower and allows landlords to sell the property at the end of the mortgage term to repay the loan. Interest-only mortgages can also be suitable in later life, particularly with retirement interest-only mortgages, where borrowers may prefer to stay in their property without making full capital repayments. Interest-only mortgage rates can vary significantly depending on your loan size, deposit, income, credit history, and overall financial position. A mortgage broker can search the whole market, compare lenders, and make sure you understand the full terms and conditions, not just the headline interest rate. This is especially important with interest-only lending, as the fine print really matters. One of the biggest advantages of an interest-only mortgage is lower monthly repayments. This can make budgeting easier and free up monthly cash flow. Some people also choose to invest the money they would otherwise be using to repay the capital. If those investments perform well, they may be able to clear the mortgage at the end of the term and have money left over. The key disadvantage of an interest-only mortgage is that you are not reducing your mortgage balance at all during the term. You will still owe the full amount at the end. Over the long term, you may actually pay more interest overall, and you also carry the responsibility of making sure your repayment plan works. If it doesn't, you could face serious financial difficulty. You're also more vulnerable to negative equity if the property price falls because your loan balance is not reducing over time. The biggest risk with an interest-only mortgage is not having the money available to repay the loan when the term ends. If that happens, you may be forced to sell your home. If property values have fallen and you're in negative equity, selling might not clear the debt, leaving you short. That's why having a realistic, documented repayment strategy is essential before committing to this type of mortgage. A mortgage broker doesn't just look for the lowest rate. They help you structure your application correctly, present your repayment strategy to the lender, and make sure the mortgage fits your wider financial plans. They may also have access to specialist lenders and products that you wouldn't find directly on the high street. If you'd like to discuss interest-only mortgages, please call us on 02380 668 407 or visit our website.